John, how you doing, mate? Episode number 2.
I'm very well, thank you. Very well. Can you hear me over the blazer?
I can hear you over the blazer. Yeah, I can hear you over the
Lovely.
blazer.
Good stuff.
So cash rate went down as predicted.
Yeah, it's been good. It's definitely made people a little bit more keen to get into the market. I think it was the cut that was needed. I don't think we're going to see any more perhaps before the election. Hopefully we'll see more later on in the year. But I think from a general sentiment point of view, there's definitely more people at open homes. There's definitely more inquiries coming in. You've probably seen it from people that are making sure, how does that impact their borrowing? Can they borrow more? What's their serviceability like now? So it's been a good result for the first quarter. Yeah.
Yeah, we've seen, I think, a lot of people that were on the fence of, oh, I'm not sure if I want to get the property yet or I'll just wait. And that first rate cut has seen mainly not necessarily owner occupiers, but a lot of people that were going to invest in either one or two more assets or get their first investment property. They've jumped on the phone and they're like, right, okay, we've got to get this done as quickly as possible because obviously everyone thinks as interest rates come down, house prices are going to soar, right? And we have actually started to see a little bit of that. I know in the eastern suburbs of Sydney, there's been a slight growth already. And in all those sort of blue chip pockets, it's started to rise already. So it's only marginally, but every little helps, right?
Every little helps, and let's not forget when people are buying a home or they're buying their investment, it's a long-term play. So you're not spending $500,000, $1 million, $2 million on an apartment or a home to then just flick it the next year because the in and out costs are just too much. So yeah, it's a long-term play from that side.
Yeah. And we had a great day yesterday. So every 6 months, YBR, who's our aggregator, they do a roadshow where essentially all the banks turn up and they try and schmooze us to send them deals and all those things. But one of the good things is we always get an economist from one of the major banks come in and talk about what they predict. What's going to happen in the next 12 to 24 months, essentially. And one really interesting thing was rate cuts. So June or July, can't remember when they actually have their meeting because sometimes they skip a month, but it's around June, July time is what they're predicting the next rate cut's going to be. And then they're not predicting another rate cut until December. And then there won't be any rate cuts throughout 2026 until at least halfway through the year. So I think essentially what they're doing is a very cautious rate cut. So yeah, June, July time, 0.25. And then December, they think it's going to be about 0.5%, which will obviously create quite a lot more demand in the market from a borrowing standpoint, etc.
And was that across the board with all of the banks? Did they all kind of share similar thoughts and feelings?
Well, look, we just had Westpac in. They changed it. The one we had 6 months ago, St. George came in, and 6 months before that, CBA came in. So they try and mix it up so we get a difference of opinion and we get to talk and ask questions to different people in the game. But yeah, interesting. I think a lot of people think that because we've started to cut rates, that suddenly we're going to get a rate cut every single time that the RBA meet, and that's just not going to happen. So I think house prices, although we might see a bit of a boom with this initial rate cut, it doesn't give people loads of additional borrowing power, So you might get an extra 50 grand maybe as a couple, 25 grand if you're a single individual for each rate cut. But in the grand scheme of things, when you're talking property prices, 25 to 50 grand isn't a huge amount of money, So I think we're probably going to see a bit of a boom, especially from the investors that were on the fence. But in regards to owner occupiers and people upgrading and things like that, I think that's still a bit of a way off yet.
Yeah, I mean, it's funny to say that we've had three new clients come on board this week to help them in their search for their respective purchases, and two of them are actually homeowners. Only one is an investor. And I think if I look at the clients that we've got at the moment that we're looking for, it's probably about a 50-50 split of homeowners to investors. So I think maybe the first time home buyers, and you'd be able to talk to this in terms of the finances you're doing, but they're probably buoyed a little bit more by the rate cap. And it's the little bit of light that they need to help them get on, because if you're a first time home buyer, an extra 25 or 50 grand can mean the difference between a good suburb and a bad suburb, or not on a main road or just off a main road. So I think they're buoyed by it a little bit more. Investors are always going to be happy with Sydney, just because of the economic supply and demand side of things. There's still lack of supply of property and a huge demand. So that's been the thing that we've noticed in our space over the last few weeks.
Yeah, and zoning changes as well. I don't know if you've been reading up on this, but there's
I
been
did, yeah.
one of my good friends bought in Pagewood about 3.5 years ago, and he sent me a message 2 days ago because they've just changed from I believe it's R1 zoning to R2 zoning, so they can do duplexes and things like that. And his property is 50 meters away from the cut off. So he's been waiting for 3 years to get a new zoning, and the line where it ends is about 6 doors down the road. So he's lucked out, unfortunately. But anyway, I'm sure they're going to change it, right? They're getting very flexible now when it comes to rezoning, which is great for owners. So if you own a property, and this is why you've got to get on when you can get on. If you own a property and suddenly that zoning changes, your land value just increases.
Massively. And then I guess some of the people in those situations, for those that maybe don't know, so what's happened is the New South Wales government has come out and rezoned a lot of places that are, I think it's 400 to 500 meters away from a metro. And so what that means is, to your point, Ross, is if you're in those areas and you can collectively get together with your neighbours, you should have developers come knocking at your door. It's that initial challenge of aligning all your neighbours to make sure that they're keen and want to get involved. So, but it will be very interesting in those areas, because I think it's Lower North Shore, it's Mossman, it's the inner west as well, and the areas that we buy in all the time where there's traditionally been those height restrictions. So I think you can go to 6 or 8 stories now.
Yeah, you can. And even just doing a duplex, right? Like we've seen it all the time where this is such a simple way to go mortgage free, because people will assume that building a duplex, your property price is going to be half, but it's not. Duplexes in Sydney, especially, if you've bought a property for say $2.5 million and you build a duplex on that piece of land, each duplex will be worth about $2.5 million. So you end up in a position where potentially you can sell a property and effectively almost pay off the other one. Obviously, you've got construction fees and things like that to consider. But if you make $1.5 million to $2 million just by selling one of those duplexes and living in the other, you've almost gone mortgage free, which is a strategy which a lot of people do, right? So a lot of people in this, they've been holding on to living in these 211 houses from the 70s and 80s, just waiting for this rezoning. So that's going to be interesting to see how that plays out over the next couple of years. But yeah, some of the other interesting stats, we're talking about Parramatta, so that popped up. Obviously, apartments are on the rise across the board. So all major cities towards the key locations, the blue chip areas. First home buyers are still heavily preferential on strata purchases. So townhouses, apartments, because that's what's affordable, right? And then they upgrade in the next 5 to 10 years to a sort of freestanding house if they can. But Parramatta popped up. Obviously, this is the importance of understanding key locations. So Parramatta apartments have been unchanged in price for the last 10 years, still remain unchanged. And that's because of dodgy builders, super high rise, extremely high strata fees, etc., etc. Houses in the same area have gone up 70%.
Yeah. I mean, it just talks to, we talk about it all the time, but it just talks to supply and demand, doesn't it? If there's an oversupply of anything, any commodity, gold, water, silver, cars, wine, whatever floats your boat, then the prices go down or there's no growth. But if there's a shortage of supply and high demand, then that's what pushes up the price. So that's where if you compare, and this is why you can never talk about the Sydney property market, because each little suburb has its nuance. Bondi Junction behaves very differently to Bondi Beach. And it's very simply because Bondi Junction, you've got lots of units, and beachside on Campbell Parade, there's not many units. So when you look at something like Parramatta, where there's an inordinate amount of units, and as you said, big sky rises, they've all got big strata fees, all that kind of stuff. You've got lots of choice. So you could argue there's an oversupply, and so therefore you don't get much growth. However, with the houses are quite rare in these parts, so that's why that growth has been going up, because there's an undersupply. And to your point, people actually still aspire to live in their own home, the freestanding home. And so that's why you would see the houses increase and the units in Parramatta not so.
Yeah, and the fastest growing areas are for houses, especially, are always the most affordable areas. So for whatever reason, I think when you're young and you still want the Cosmo lifestyle and the beaches and stuff, you're happy to go into the strata title units and live in those sorts of areas. And then as you sort of get kids and you think about catchment zones and things like that, then you feel like you can push the boundary and get into that freestanding house. You start to sort of move to the outer suburbs and have a little bit of a tree change, I suppose, which is why we've started looking at Southwest Sydney properties that have been growing at the fastest rate because they are the most affordable freestanding houses, essentially. But yeah, really, really interesting data coming out at the start of the year, first quarter. But and lots of changes from our perspective. Generally, over the last 4 years, 3 or 4 years, the main lenders that we've been using have been the big four: Westpac, ANZ, CBA, and NAB. And what's happened now is there's been a lot of interest in private lending and low doc lending strategies. So for a lot of people that don't understand what alt doc and low doc lending is, essentially the big banks have more restrictions around their policies. When you go to private funding, there's a lot more discretion, a lot more big picture. What's this person like? What's their goal at the end of this? Is this a short-term loan? And what we're seeing is a lot of people jump onto old doc and low doc lending. And what they're doing is they're pushing their borrowing power to the absolute limits now that interest rates are still very high. But they're doing it through private banking, which is generally, if you look at it, it's about 1 to 1.5% higher on their interest rates, and there's fees involved. But what they're doing is they're jumping on with these lenders for 24 months, entering the market, and then they're switching back to a sort of big bank in 2 to 3 years' time. So there's been a huge uptick in all of these lenders being used as a stepping stone strategy to get into the market. And some of these lenders are doing 40-year loan terms, monthly lenders, mortgage insurance. So there's lots of ways to get into the market if you want to.
Yeah. And what's the kind of people that you're seeing that are taking up these options? Because I guess I've always been on the thought process that the low doc stuff is, and the private lending is more for perhaps a sophisticated investor, or perhaps high net wealth people that are perhaps got a bit more disposable. But who are you seeing taking up these strategies or these terms?
Sometimes it's people that are tax efficient. If a lot of people that are starting businesses in their first or second year, maybe their ABN isn't 2 years, so that suddenly waves off the big banks, or they've been using a lot of their disposable income within the business to essentially grow the business, right? Which is what you need to do in the startup phase for the first 2 3 years. But what a lot of low doc lenders do is they look at what your ongoing income is. So they get a letter from your accountant to say not what your past income is, but what are you seeing this month and moving forwards, and you basically sign off on that. So if last year you only made 80 grand a year on taxable income, but for whatever reason, all of that equipment that you've just purchased, or vehicles that you needed, or the new office, etc., has been fitted out, that's all been done, and now you're clear of that, and you're making 20 grand a month as an example, or 15 grand a month. That's double what you made taxable profit last year. So you can actually just sign off with an accountant. Yeah, cool. You pay 1.5% higher, but it gets you into the market, gets you into an asset, and if you buy in the right area, that extra 1.5% that's maybe $300 or $400 a month difference. You're gonna surpass that in growth and capital gains by fivefold, tenfold, So they're using that as a stepping stone lender to then go back. What we do is we'll take them on there for 1 to 2 years, and then we'll take them back on to a normal, cheaper funder at a later date. But it's interesting, 3 or 4 years ago, that they weren't talked about at all, really. Like you say, sophisticated investors were mainly the ones that used those, or people that expats offshore using those types of lenders. But now it's just your everyday mum and dad or first home buyer which is jumping on with these guys because they've got stretched policies or lower buffer rates, which means that they can borrow more money. But yeah, interesting to see.
Yeah, I think you raise a good point about business owners. And so we deal with a lot of business owners, small business, global businesses. But what tends to happen is, as a business owner, you kind of say, I want to pay myself as little as possible so I pay no tax. But then when it comes to the borrowing side of things, because their incomes are so low, they haven't got any borrowing capacity. So they can't buy that home or that next investment or even the first investment. So a lot of times, and you'll be able to talk to this as well, it's kind of reverse engineering the thought process to say to your accountant, well, okay, I want to pay myself X because I want to buy X property. What do I need to pay myself? What do I need to be billing? How do I get there? And so it's working with a broker, working with an accountant, even a financial advisor, bringing that team together to make sure that the numbers make sense and get there in the end, rather than saying I pay myself minimal salary because I don't want to pay any tax. Tax can be a good thing.
Yeah, and one thing you'll find as well, you'll see this, is you'll have clients that get into their first asset, right, and they get some great gains in the first 6 months, and then they want to recycle the debt, revaluing the property, extracting some equity, maybe $100,000 to $200,000 from that asset, and then they want to get a pre-approval for another property. But what we're seeing a lot now is that the bank will give them enough leverage for the refinance, but what they're not giving them enough leverage for is the pre-approval for the next property. So they're using these tier 2 funders with lower buffer rates, etc., or these sort of non-bank lenders that have got less restrictions to get them into that second asset or that third asset where they're stretched for borrowing power. But yeah, it's business has been good and there's a lot of uptick, and it's good to see, because I think there's been a bit of a negative association with sort of property and investing over the last few years. Obviously, all the especially after COVID, right? So we had COVID and then straight into loads of rate increases. But it's good to see that there's more positive attitude towards it now.
Yeah, very much, very much. And I think for people that are getting into the market, property is a huge wealth creation tool, all around the world. But certainly here in Australia, I always joke and say, property is like a sport here. But it is what is, in the same way that when you contribute to your super, it's the compounding that makes you the money. It's having the growth over 10, 20, 30 years. It's exactly the same with property. So you're never going to get the perfect conditions to get into the market. You're never going to get low interest rates, cheap property, competition, lots of supply. You're never going to get all the factors that align to make it easy. But you just got to get in when you can. That's where talking to a broker like yourself and looking at the different options, because if you can get in now and hold on for the next 10, 20, 30 years, it's that compounding, it's that time in the market that's actually going to make you money, which gives you options later on in life.
Yeah. And interesting that you touched on super there, because this is one of those things as well that we used to see the sophisticated investors, they stretch themselves to the absolute limits and then they use their super to buy more assets. But the normal everyday person, we've just started to see using their superannuation to purchase property, which I think a lot of people don't really know that they can do. So what you do is you essentially take your super balance, and if you've got a partner, great, because you can combine your super balance under a self-managed super fund. And then you set up a trust, and then essentially buy an asset through your self-managed super fund. Let's say you've got a couple of $100,000 in there, you can buy a $700,000, $800,000 investment property. What you can't do is release that money, so you can't give it to yourself. It's literally for your retirement, right? But it's a very clever way to take your 200K balance up to an 800K asset. Suddenly, instead of your 200K asset growing at 10% a year, you've got an 800,000 asset that might be growing at 6, 7, 8% a year in the property market. And your employer, who is paying into your contributions and the rental income, is effectively paying off that loan. It's not coming out of your pocket 99% of the time. So it's a great strategy. We started seeing a lot of it recently, and I think there's going to be more of it. There's more and more lenders jumping onto self-managed super fund. I think a lot of people are going to be using it over the next few years. Yeah, really cool.
Yeah.
Any last thoughts for us, mate, to wrap the episode up for today?
No, I think look, if you're interested in doing something this year, I think now's a good time. Just get curious, get yourself a dream team, get yourself a good broker, get yourself an advisor, and speak to your accountant. Speak to a buyer's agent if you're struggling, but take action, because it's the opportunity cost of doing nothing.
Exactly. All right. Cheers, buddy. We'll catch you on the next one.
See you later.